Welcome to Market Catalysts. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, the Trump administration reiterating August 1st as a hard deadline for new tariff rates. Other countries and regions continue to negotiate and to prepare for worst-case scenarios. Plus, investor playbook, how to position your portfolio ahead of Mag 7 earnings this week. And President Trump signing the Genius Act into law. We'll discuss what happens next, including a potential flood of new products aimed at consumers. Let's get a check of markets right now. We are seeing a rally underway here. The Dow is up just about 150 points, about a third of 1%. The S&P and the Nasdaq each touching intraday records once again, with the S&P gaining half of 1%, and the tech-heavy Nasdaq, ahead of all those Mag 7 earnings this week, is up nearly 0.75%. And let's take a look at the bond market as well here this morning. There, we are seeing yields pull back pretty meaningfully here, down 6 basis points on both the 10 and the 30-year. The 10-year down to 4.38%. Well, Alphabet and Tesla are the first names in the Magnificent Seven set to report earnings this week. Joining me now with their top picks among the biggest names in the market, George C., Annandale Capital founder and chairman, and Olivier Blanchard, Futurum Research Director for Semiconductors, EVs, and Autos. Gentlemen, thank you for being here. George, I'm going to start with you. One of the sort of ongoing themes we've been talking a lot about this morning is that even if companies beat estimates, that doesn't mean the stocks necessarily go higher. And I'm just curious, from a big picture standpoint, how you're thinking about how that could apply to some of these Mag 7 names.
Well, that's the pertinent question, actually, because if you're a money manager and you're trying to do right by your clients and yourself in terms of performance, you want to try to double your money on these kind of investments as rapidly as you can. I think 5 to 7 years is a appropriate benchmark to do that in. And I think it's really hard to look at any of these companies except for Google and say you're going to do that in that time frame. They're very, very expensive. It's hard to see them getting doubly that expensive in a short period of time. So I think that the risks are kind of against you at this point. You've got to be kind of circumspect in terms of when you want to buy into these companies. They're great companies, but great companies are not always great stocks. And you look at the Nifty 50 back in the 70s, and you look at all the tech stocks before the tech bubble popped in 2000, and you think, maybe we ought to just watch for a while, because they got to beat really, really big for them to keep going up extensively.
George, you mentioned that Google or Alphabet would be the exception here. Why?
It's just so cheap. Everybody's so down on all the antitrust actions against Google, and they're really down on the stock, and they've driven it way down from a multiple standpoint. I think the odds are in your favor with Google. I think it's just such a great company. It's got so much going for it, and if it eventually gets broken up, the parts are worth a whole lot more than the aggregate right now that in one stock. So I don't think it'll get broken up. I think it'll stay together, but I still think the odds are in your favor with Google. The rest of the stocks, especially Apple and Tesla, I just don't think you've got the odds are in your favor right now.
Olivier, I want to get your take on Alphabet and how you think it is positioned here from a fundamental standpoint versus some of its competitors.
Hi, Julie. I think George is right on a lot of the things that he says. I agree pretty much with everything that was just said. I would just add that Google has a really, really strong position in AI. And I know that in previous segments, and just as kind of like a general discussion, OpenAI has been sort of, eating into the market share of Google's kind of like AI business. But Gemini is super strong. It has super strong integration into all of its products. And I feel like ultimately all of this is just an ROI discussion, right? Which companies can cut costs the most and which companies can generate the most revenue, the most profitability. Google is still sort of like in the building phase with Gemini, and it's outpacing a lot of its competitors. I wouldn't say that it's ahead of OpenAI necessarily, but I think that basically when we're talking about agentic AI, we're talking for consumers especially, and search. We're talking about OpenAI and Google. And then in the enterprise, we're getting into AWS and Azure. But Google has a really strong position there. And I'm just generally impressed with how good Gemini is, how well integrated it is in every single product, whether it's hardware, software, search. It's just a revenue machine just waiting to sort of find its paces in terms of how they're going to generate that revenue, but it's scaling.
Well, and Olivier, something else that's interesting when you talk about the ROI and the cutting cost side of the equation, something else that is bubbling up more and more is the cost savings that AI is presumably going to afford not just these companies, but maybe all companies. And I don't know if, besides Meta sort of throwing millions of dollars at individual executives to come over, are we going to see sort of a wholesale cost savings across the board once AI starts to take hold a little more firmly?
Yes and no. There's a cost shifting for sure. I don't know that there's necessarily a cost savings because on the one hand, training these large AI models is extremely expensive. Investing in the infrastructure that supports that training and then later on inference is also really expensive. So you're seeing all of the spending in data centers and chips, which is obviously really good for NVIDIA and AMD and TSMC and all the chip companies in that ecosystem. But right now it's still cost shifting. There's also a lot of energy concerns, the energy consumption of training AI. But the one hopeful thing that I have and that we'll probably see towards the end of this year, beginning of next year, is I think we're going to achieve parity between AI training and AI inference. And inference is kind of like the workloads of you asking AI to do something and it just does it for you. The training is a lot more power intensive than the inference. And so I think that as we transition from a primarily training phase of this AI revolution to an inference phase, we're going to see the market shift. And when the inference really kicks in, that's when you should start seeing a lot of the applications that allow people to be more productive. And those productivity gains should sort of overpower or compensate the initial costs of getting that going. So we'll see that shift start to move towards the end of this year, beginning of next year.
And guys, I'm going to ask you something else that I think you agree on, and that's about the other Magnificent Seven name that's reporting this week, which is Tesla. George, you're not interested in owning Tesla, I guess, going into the earnings or at any time?
At any time. I just don't see the compelling nature of owning Tesla. I've never owned it. I don't plan to own it. I'm not shorting it. I don't want to bet against Elon Musk. That's been a bad bet for a very long time, but I see better opportunities out there than Tesla.
FOMO is not an investing strategy, George?
Not for me, no.
Olivier, what about you when you look at your analysis of Tesla?
From a technical standpoint, unfortunately, I haven't seen really a lot of innovation come out of Tesla. I'm not seeing any exciting. The designs are still just, it's not competitive with companies like BYD, for instance, in China and Europe, that are essentially putting out very similar products to Tesla, but better and more cost effectively and with better battery life and better, faster recharging rate. So what I'd like to see from Tesla is a real turnaround in terms of innovation and product design. And that's a long runway in the automotive industry. You could turn a company around if you're building smartphones and computers in 18 months. For Tesla, you're looking at a cycle of 2 to 3 years minimum. So even assuming that Elon Musk completely focuses on Tesla for the next couple of years, you're still not going to see that turnaround for a while. And so I'm just not enthusiastic. I don't know that Tesla is part of the Magnificent Seven next year. And for me, it's kind of like, it's something that I say as a sort of a snarky joke, but I just don't see how Tesla comes back anytime soon.
Yeah, and the if of him spending all of his time on Tesla is a big one, obviously. And finally, George, the other, when we're looking at the Mag 7, the other comment from you that really stood out to me had to do with Microsoft. You called it, in your note, arguably the greatest company in world history. That's quite a statement, George. What supports that in your view?
Oh, I think it's completely accurate. I mean, the run they've had, how long they've been around. You look at Cisco Systems, and that was kind of the stock back 25 years ago, and they've never reached their all-time high they reached in 2000, whereas Microsoft is roughly 10 times higher than that now. And they've been so well run for so long, and they've been on the cutting edge of so many different things, and they're very innovative in terms of the new markets they rush into and rush into successfully. I just think it's astoundingly successful, and I think it's likely to continue on past NVIDIA, past Apple, past Cisco Systems. Everything else has been kind of their competitors at the top of the food chain because they're so diverse and they're so well run. I stand on that statement.
All right, and they report on the 30th, so we'll be looking ahead to that. George, Olivier, thank you so much. Appreciate it.
Thank you for having us.
The Trump administration is firm on its August 1st deadline, it says, for trade deals. That's according to Commerce Secretary Howard Lutnick. He said on CBS News over the weekend that it is a hard deadline for when new tariff rates will set in, but that countries can still negotiate after that date. So where are we with some of these trade deals? Joining me now with the latest, Yahoo Finance Washington correspondent Ben Worshall. And the negotiations with the EU seem to be most in focus right now, right?
For sure, yeah. Europe is definitely most in focus this morning amongst these wide range of deals. And what we're getting on the Europe side here is sort of a picture of what a no deal scenario looks like. There's a bunch of reports from Brussels in recent hours of what EU countermeasures could be if no deal is reached by August 1st. The big ones would be retaliatory tariffs on a wide range of U.S. goods, from steel to bourbon to a whole bunch of goods. A big escalation would be what are called anti-coercion measures that the European Union has, which could allow them to simply restrict trade. That would obviously be a massive escalation here in terms of the standoff between the U.S. and the EU. But it does come, I should note, as both sides say that they are looking. They are still negotiating. They're still confident that in some cases, confident that there could be a deal. On the early side, Lutnick also said on CBS over the weekend, there's plenty of room for a deal. So and that he was talking to them as recently as Sunday. So there's still lots of back and forth there, but it's kind of a get ready for the worst case scenario if that comes. One other nuance I think is important for investors to note, and you saw it in that Lutnick quote, is they're saying the White House message is evolving a little bit to say that there is a firm deadline for tariff rates on August 1st, but not necessarily tariff trade deals. Lutnick had the comments. Bessent, Secretary of the Treasury Scott Bessent, this morning on CNBC had a similar line about how they're not looking to rush deals. They're waiting for high quality deals, is how he put it, which could give us a little wiggle room on this August 1st deadline for deals, but according to the White House, not necessarily tariffs. Another front in this that I think falls in this similar theme is India, which Indian negotiators were here in Washington just this weekend for a fifth round of talks. They came away, according to Indian media, confident in what they describe as a mini deal, but with a key caveat here, any announcement is not likely to come until September or October. So the emerging question is kind of what happens in August and September as these deals aren't necessarily done, but Trump has promised rates will go into place.
Yeah, the message seems to be that they're not pushing it back again. Is that the way to read it?
Yeah, I think on all these fronts. So it's the overall dynamic here, I think, is, and especially true with Europe, is that Trump team keeps asking for additional concessions. We had reports a few weeks ago of there seemed to be a consensus around a 10% tariff on the European Union. That is clearly less likely now. Trump and his team are floating things like a 15 or 20% rate, and his letter last week was a 30% rate. So there's definitely a lot of pushback on both sides on all these fronts, with Trump and his team, in their own accounting, pushing for the best deal possible for certain. And it could go right up to this August 1st deadline or even beyond.
Ben, thanks a lot. Appreciate it.
Good thing.
Coming up next, we're talking pizza. Following Domino's earnings, we'll get an analyst take on the numbers. Coming up, you're watching Market Catalysts. Domino's giving up on some earlier gains after it topped second quarter revenue estimates boosted by strong same-store sales growth. Joining me now, Danilo Gargiulo, Bernstein senior analyst for U.S. restaurants. Danilo, it's good to see you. You've got a neutral rating on the stock, but you did, like most of your peers, you were impressed by these results. Was there anything on the call or in the results that you think could be responsible for the pullback that we're now seeing in the shares?
I will actually point something else. Maybe during the call, there were a couple of comments that I think were incremental that the CEO Russell was trying to explain, not only the strength of the fundamentals of Domino's potentially enduring into 2026 and the international markets, having some sort of recovery overall. I think there were a couple of comments that were interesting on the potential menu platform expansion that Domino's could be having in 2026. Or beyond, that could be driving the stock further. But I think to your question directly on the potential pullback that we might have seen, I think the uncertainty on international markets regarding the number of units, given the situation that is unfolding with one of their master franchisees, could be the potential cause for this deceleration.
Gotcha. Interesting. So the shares are now down about 2%. But to your point on the longer term, How much was sort of menu innovation? I mean, if you're looking out further and seeing more menu expansion, how much was menu innovation a driver for traffic and sales in the quarter?
Yeah, I think it was a significant component of their acceleration, and it has been a significant component of Domino's acceleration. If you look at also the past 10 years, right, they've been gaining market share quite consistently over the past 10 years, where others have been closing their stores. Domino's has been able to open their stores. And part of the reasons why Domino's has been able to boost it is because the franchisee economics has been relatively solid, given that the menu innovation has also attracted more and more new consumers. So specifically this quarter, there has been a boost in sales derived by the launch of the Parmesan stuffed pizza last quarter. That should be helping for at least the remaining of 2025 and into 2026, the sales to remain sustained.
I'm also curious, the company also talked on the call about the national rollout on DoorDash, and that is a potential driver here. How much do you think that's going to help traffic?
Yeah, I would say so far it has been relatively minimal impact into the 2Q numbers, simply because the timing of the partnership was toward the end of the quarter. But I think we have seen also with Uber Eats that exit rate of end of last year, it was about 3% as a total sales that Domino's was generating in the US. And so I would think that DoorDash having twice as much market share compared to Uber Eats could be a meaningful contributor to Domino's sales going forward. The only question is going to be how much of the overlap might be we seeing from users who are both Uber Eats and DoorDash users. So how much of that could be potentially a drawback into the overall upside optionality that this platform will provide to Domino's. But definitely there is a set of consumers who don't have their Domino's apps, and by having just an aggregator on their mobile phone are going to be having access to Domino's Pizza, right, whereas before they couldn't.
Danilo, what about the cost side of the equation? I saw one of your peers, another analyst, flag that there was some margin compression. What accounted for that, and is that going to continue to be an issue?
Yeah, I would say there were two main components. On the food side, I think we were not particularly worried because management had already called out the potential fluctuations on the food. The part that really was a surprise for us, and I think for everybody, was some one-off impact that some insurance charges really had on the second quarter earning. This should be like a one-off, so I'm not entirely worried. Now, clearly, as we think about the value intensity in the pizza category, and if we think about some of the mix shift that we might be seeing because the carry-out component of Domino's is growing, then clearly there could be some potential margin compression over time, like marginal margin compression over time, that one should be potentially expecting for Domino's, given that the vast majority of the productivity gains has already been achieved by Domino's.
And Danilo, as I mentioned, you've got a market perform, a neutral equivalent on this stock. I'm curious why, especially given these results, what's still sort of holding you back from being more bullish?
Yeah, I think most investors will want to see a couple of things. Number one, either a better entry point, right? The stock already trading mostly in line, if not a little bit above their 5-year median in terms of valuation. That clearly calls out for sustainable same-store sales growth and acceleration in unit. And I think, obviously, you will want to see some elements of that sustaining over time. And then the second part that investors have been a little bit more concerned about is how much of these 2025 outperformance in the first quarter, which, by the way, is going to be accelerating in the second quarter as well because of the timing of some of these initiatives, how much of that is going to be retained in 2026 when you're going to start lapping the launch of the stuffed crust pizza, the launch of the DoorDash partnership. So any incremental news, like new menu items, like the one that Russell, the CEO, was mentioning in the call, like the potential fried chicken addition into their menu, that could be a clear catalyst for the stock reacceleration and sustainability of an even higher multiple versus their historical median.
Danilo, when you're looking ahead to some of those other innovations maybe on the menu that we're waiting for, any requests, anything that you think that they should be developing?
Look, I think the Wingstop example really is clear. The having fried chicken has been working thoroughly in many parts of the world. I don't know if the the version that Domino's has necessarily on their menu could be as satisfactory to the vast majority of consumers as of now. So as Domino's is exploring the void areas into their menu, and now they have the capacity into the stores to potentially adding some fryers, I would think that could be like a potential venue for them to be entering a little bit more aggressively. Other than that, there is always opportunity to be a little bit more streamlined in some SKUs that don't have the highest level of velocity. But I would say fried chicken seems to be the place where everybody's trying to crowd the market right now, and it would be like a safe bet.
A little side of wings with your pizza. Danilo, thank you so much. Appreciate it. Good to see you.
Thank you. Likewise.
Coming up next, we'll take you through some trending tickers, including a new entry into the S&P 500. We got much more coming your way. You're watching Market Catalysts. 1 hour into the start of trading, let's get a check on the markets. We are seeing all three major averages rise here today. The Dow most modestly. It's up right now about 160 points, about a third of 1%. The S&P 500 looks like it is rising to another record here today. There you're looking at the daily performance of that index. If you look at year to date, you can see the rise a little more clearly and the new record status again for that index. Same goes for the NASDAQ, which is up about 0.8% today and hitting a new record in today's session. In terms of what is pushing things higher today, here's a look at the NASDAQ 100, and we see definitely some of the largest cap tech stocks gaining a bit here. Not huge gains across the board, but Alphabet gaining about 2% ahead of its earnings. You see Broadcom stands out as well, as up a little more than 2%. And then if you look at the sectors within the S&P 500, only energy in the red today. You've got the XLB Materials Index rising the most, followed by communication services and tech in the form of the XLK. Going to take a cue from my colleague Jared Blickery and take a look at the leaders, the sentiment markets as he calls them. You've got this IPO index in the upper left here. This looks at, it's an ETF that tracks companies that have come public in the last 12 months. As we know, we've seen some real runaway increases there, including a stock we're going to talk about momentarily. So that has been an interesting move that we have seen upward here. South Korea ETF moving up by 2% today. That's an interesting one. And then Cathie Wood's ARK Invest up by nearly 2% today. You've also got an increase in stocks tied to cannabis. That's the MJ ETF. And solar in the form of the TAN ETF. So some of these sort of more meme or momentum type trades are also gaining a little bit of steam today. Let's talk about some individual. Now it's time for some of today's trending tickers. We're watching Block, Pinterest, Etsy, and Target. First up, Block is set to join the S&P 500. It will replace Hess, which of course is being acquired by Chevron. That change will be effective July 23rd. The fintech company helmed by Jack Dorsey up nearly 8%. As a result of that addition this morning. Originally, of course, a payments processor, Block, which was known as Square and is still known by the brand name Square, has expanded to offering payment services through Cash App. It also received approval from the FDIC to offer consumer loans. However, it has struggled with uneven financial results, cutting its full-year forecast in May, which sent the stock at the time to its lowest levels since November of 2023. Right now, it's up 7.5%. Next up, social media platforms Pinterest and Etsy getting upgrades from Morgan Stanley. In a note from Sunday, shares of both media stocks on the rise this morning. Pinterest was upgraded to overweight from equal weight. The price target raised to $45. Analysts there citing GPU innovation and the potential for a positive surprise in second quarter earnings. Etsy was boosted to equal weight with a price target to $50, but also offered some long-term caution, the folks over at Morgan Stanley, when it comes to that platform's ability to drive more user frequency. And finally, Barclays analyst Seth Siegman downgrading Target from equal weight to underweight, maintaining his price target of $91 a share. That report arguing that Target's sales could continue to fall without a strategic revamp. In the first quarter, Target reported a larger than expected drop in sales. It confirmed it expects those numbers to continue to drop for the rest of the year as customers shop less. The shares this morning, little changed. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up next, crypto legislation has now been signed into law. What happens now? We'll tell you coming up. Bitcoin, Ethereum, and crypto-related stocks are on the move higher this morning, days after President Trump signed the Genius Act into law, making the first major piece of crypto regulation. Here with more on where crypto goes next is Brady Dale, Axios crypto reporter. So that was the sort of landmark, Brady, that people in the industry pointed to, the first big legislative win for them. I think there are a lot of questions now about what that unleashes, like what happens now in terms of tangible products, changes to the industry. What are you watching most closely?
Yeah, the thing I'm most interested in is if consumers actually start to adopt stablecoins. It's tough to get people to adopt new ways of payments here in the US. But if they do, it could be really good for small businesses, retail, which all have a very narrow margin. Stablecoins give them a way to have a digital version of actual cash we keep in our pocket. And the reason cash is nice for retailers is because it doesn't come with those interchange fees that credit cards have. Well, stablecoins would be pretty much the same. And so I think we'll see merchants starting to urge people to adopt stablecoins, but who knows if they do.
Well, and I mean, don't we have a digital version of cash already, which is just cash, right? Like Venmo and things, there are ways obviously to transact online without credit cards, I guess just not that many. So would this in theory make all of that easier?
Yeah, it would make it all easier. It would make it all faster. You don't have to have a third party involved. And, zooming out from that, Venmo doesn't work internationally.
Right.
You can't pay people abroad with it. So there's a bunch of other, more boring in the weeds sort of businessy things that we'll see folks use stable coins for. But in terms of like just the average person on the street, the thing I'm curious about is if, normal American consumers start to use it.
And what are we seeing in terms of the industry sort of preparing for that or trying to push that forward?
Well, I mean, the crypto industry itself has been all in on stablecoins for a long time. A lot of them call it the first killer app of blockchains. I think the thing that I'm curious about is, the industry is going to try to own this space. Circle, Tether, they're going to try to be the Microsoft and Apples of the stablecoins future. But the thing is, a bunch of the big banks like Bank of America, Citi, all of them are also talking about getting into the stablecoin game. And of course, they have a lot more access to a lot more people more immediately, and they're more trusted names. And so I think it's not so much what the industry does, the existing blockchain industry, as it is like the banking industry. How do they get into it?
You also recently wrote about some incentives that the industry is sort of offering or poised to offer in terms of things like cash back when people use stablecoins. I can't help but think of the BlockFi situation when I see things like that, where they were offering interest on crypto deposits. It didn't end well for the folks who were doing that. So now, with that in mind, how does the industry sort of convince people that this is not a risky situation?
So where the more conservative interest that you see on apps like Coinbase and PayPal, where you can deposit stable coins and get 3 or 4%, I think it's closer to 4% these days in return, where that comes from is just from US Treasuries. The problem with BlockFi is it was making all these very risky loans to hedge funds and things like that, and nobody knew that's what they were doing. And that is, it was a lot riskier, right? But these high percentage rates, that definitely beat your savings account, that Coinbase and PayPal are getting on stable coins, that's just US Treasury returns. That's all it is. And so it's extremely safe. And stable coins, they don't lend the money out like banks do. So it's all there. It's 100% backed.
But do they then make anything from it?
Well, so yeah, it's a great question. So the reason why Coinbase and PayPal are giving basically all the interest to users is because they're trying to get people to start using their coin. So yeah, their margins at that point are really tiny. It's also not that hard of a business once you've got people in the door. You put the money in the bank, you turn it into treasuries, it makes a return, you spread it around to your users. That doesn't take a lot of people to do it. But yeah, that is going to heavily shave into their margins. Their theory is if they can make their stablecoin popular, they'll be able to build more businesses on it down the road.
Right. So we've been talking all about the Genius Act and what came from that. What about the Clarity Act? Where is it now, and what is that poised to do?
Yeah, great question. So the Clarity Act started in the House. That's the bill that would sort of regulate the whole world of cryptocurrency. So, for anyone who's been even mildly following this topic the last several years, this question of what are these things, who regulates them, all that stuff has been up in the air for as long as I've been covering this stuff, which is like 8 years now. And so the Clarity Act will nail all that down. And so the House passed it last week, and it is now before the Senate. We expect the Senate to put out its own kind of draft language this week. There'll be some negotiation around that. And President Trump has said he wants the law finalized and on his desk by the end of September. So that's the state of play. If that bill passes, crypto won't be the quote unquote Wild West anymore. There will be new updated rules that actually reflect how this technology works.
And speaking of Wild West, maybe, we had the latest company this morning talking about a Bitcoin treasury investment, and this time it was DJT, Trump Media, which is not surprising, right, given the Trump himself and the family involvement here. But what do you make of this trend that we have seen of all these companies, jumping on the crypto treasury bandwagon?
Well, there's two kinds, right? So for folks who are thinking, is this good or bad for my portfolio? If it's a company that is making some money, they've got some extra profit, they aren't immediately sure what to do with it, so they buy some Bitcoin in the meantime. That's kind of the block model. Then there's not much concern about it. Bitcoin could go down, but it's been doing pretty well over time. The dicier thing is there's a bunch of companies coming along that are actually, their whole thing is just buying Bitcoin, and they're buying it on leverage. And so that obviously gets a lot riskier. And if that bet starts to unwind, it's going to cause a lot of sales of Bitcoin really fast, which won't just hurt that company, it'll hurt the whole Bitcoin market. So we could be kind of stacking up risk with those companies. But if a company's just buying a little Bitcoin on the side, it's no big deal. And I think that's more the model that Trump is doing right now. And like I said, companies like Block or Tesla, which also have some Bitcoin.
And Brady, finally, we're covering a lot of ground here. Finally, I want to ask you about Polymarket, because Polymarket got the go-ahead from the DOJ to re-enter the U.S. market. Bloomberg is reporting this morning that they're buying a derivatives exchange that is not very well known called QCX, and that's how it's going to get back into the U.S. What do people need to know about Polymarket, which is sort of crypto betting platform, versus maybe some of the other betting platforms that are out there?
Yeah, so Polymarket is a market that uses blockchain technology, but it's not an exchange for trading like Bitcoin and Ethereum and things like that. Polymarket is a market for making bets on real world events. They call it a prediction market. And the theory is here that people who have real information, who don't want to tell it to the world, kind of put that information into the market by making bets. And so this was something that we all got very interested in during the last presidential election. It looked like Polymarket was right when the rest of the world was wrong. And it's like any kind of betting. If folks are thinking just about starting to play around with this, don't put in more money than you can afford to lose. But it is sort of a new category of financial product that sort of lets you let you settle some of those conversations you have around the bar with money on the line in kind of a fun way, if that's what you want to do.
Yes, we'll keep an eye on that closing of that acquisition to see when it actually re-enters. Brady, thank you so much. Really appreciate it.
Thanks for having me.
Coming up, Stellantis is warning of a multi-billion-dollar shock, in part due to tariffs. We'll explain on the other side of the break. Stellantis expects to swing to a net loss of $2.7 billion for the first half of the year due to pre-tax net charges and the effects of tariffs. Here with more context is the host of Market Sunrise, Ramzan Karmali. Ramzan, what's going on here? I mean, we've heard from the various European automakers, and they're a little bit all over the map with the sort of reaction to tariffs and how they're handling all of it.
Yeah, so it's interesting to note, don't forget, Stellantis is the fourth largest car maker in the whole world. It's responsible for 14 brands. Probably know them for Chrysler and Dodge and Ram. And this loss of 2.7 billion on the face of it looks pretty bad, but it looks even worse if you compare it to the same period last year. Last year, it actually was making, for the same period, a profit of $6.5 billion roughly. So this number is pretty dramatic. They say that about $350 million is down to the tariffs, but it's also facing some huge charges. For instance, it's decided to pull out of making hydrogen cars, and that's cost it money. But also it's facing charges of in total around $3.85 billion. And that's also to do with new EU regulations on carbon emissions as well. It's light vehicles, commercial light vehicles have been pretty slow at changing over to being battery-only engines. So that's really hurt it as well. So the business itself is also going through a bit of an upheaval as well, it's fair to say. You might remember Carlos Tavares, he was the CEO for 4 years roughly. He quit suddenly in December. For 4 months, they didn't have a permanent CEO. It was an interim CEO, and the actual current CEO only started in April. He was the boss of the North America division, Antonio Filosi, and he is being charged basically with turning the business around and resetting the on switch for Stellantis.
Ramzan, all of that sounds like an uphill battle, and yet the shares are higher at the moment. What's going on there?
So the shares for instance, Stellantis has shares listed not just in New York, but also in Milan and Paris as well. In Milan, in early trade, they were down over 4% at one point. They've recovered there. In the US, as you can see, they're up now around over 2%, but they were down in pre-market quite heavily as well. What's going on here is I think that maybe there might have been an overreaction perhaps at the start when they saw this big loss. But analysts also point out that actually Stellantis, compared to its rivals, is quite well positioned in North America. And North America is clearly the problem area for a lot of these European car makers. But Stellantis is quite well positioned because it has a lot of production in the US and it's pretty compliant in terms of tariffs with Mexico and Canada as well. And so I think that probably may be outweighing some of the doom and gloom that we may have heard earlier.
Right. And also context here, the shares are down 28% this year, at least the US shares, even with the little bit of a bump today. Ramzan, thank you so much. Appreciate it. Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, the U.S. economy looks strong, but one economist expects, quote, summer turbulence in markets. Plus, Investor Playbook, we dig into the state of the travel industry by the numbers and talk about travel stocks reporting earnings this week and how investors are using options to trade Tesla ahead of earnings. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets right now. We are seeing all three major averages push higher with the S&P and the NASDAQ at new records here. Holding pretty steady with the NASDAQ in the pole position up about 0.75% as we see a lot of those Mag 7 names rise ahead of earnings from both Alphabet and Tesla this week. Let's also check on gold prices because even as we see stocks rise, we're also seeing gold rise here, up above $3,400 an ounce, up about 1.7% today. Well, as we see stocks back at all-time highs during Trade Monday, it comes as the U.S. economy appears to be resilient, bouncing back from tariff-induced shocks with higher-than-expected retail sales in June, and inflation for now relatively stable, hovering just below 3%. So will the rally continue, or could there be more market volatility on the horizon? Joining me in studio is Chris Watling, Longview Economics global economist and chief market strategist. Thanks for being here.
Thanks for having me. Appreciate it.
So, Chris, it's been so interesting covering economic forecasting over the past few years because economists on average keep expecting things to go worse than they do. And that seems to be unfolding once again. Is that how you read it?
Well, economists are a terrific bunch. They're generally wrong as a group, sadly. So, in fact, the IMF did a study of that once, showing how economists are very poor at getting turning points in the economy. It's very easy to extrapolate the same old, continuing. How do I see it? I mean, I think the U.S. economy is getting softer. And the way I really think about it, big picture, is under President Biden, there was enormous amounts of fiscal stimulus. You remember all the fiscal packages, and money was tight. And then under Trump, initially, I know we've got a one big beautiful bill out there, but initially fiscal tightening and monetary policy is still tight. Just look at housing. There's nothing going on, no activity. If you look at the industrial cycle in the US, it's flat. There's no growth for 3 years. So there's tight money and tightening fiscal. And then when you really start to dig into the detail, I know you can pick your nice data points. Retail sales looks better and this and that. But in aggregate, I think the data looks pretty soft. Look at services ISM, barely at 50. I mean, that's terrible. I mean, normally you'd say, I mean, ISM manufacturing's been below 50 for 3 years pretty much, which is quite something. And services is sort of at 50. You know, that's pretty troubling. That's not an economy that's any better than stall speed, really.
Do you also believe that the tariff shock is coming? You know, we keep sort of waiting for it, and it shows up here and there, but we haven't seen that big shock.
Well, I think it's slowly accumulating, isn't it? You know, some tariffs are going on, the odd deals being done, stuff's getting pushed back, but it's coming, and more deals are being done, and none of them are really surprising significantly to the downside. They're mostly a little bit more than you might expect. So it's clearly not a positive for the global economy. It's definitely a net negative.
It's curious then, as we have this conversation, to see U.S. stocks back at record highs, right? And so do you think it's just that most market participants are not reading the data as you are and seeing it negative, or it has to be much more obviously turning for markets to turn also?
Well, I think what happens is markets swing from greed to fear, fear to greed. I mean, I was last on April the 7th. I remember it very well. It was the low of the day, and the market actually moved 10% whilst I was on. It was extraordinary. And of course, that was telling you at the time people wanted to buy it. There was so much fear around, but the fact they could bounce at 10% an hour was telling you that actually there was underlying need to buy. Everyone was short and everyone was bearish. So I think we're at the opposite now. We've rallied hard since April the 7th. We've gone up a ton. The Max 7 have been amazing, and Nvidia's been breaking out to new highs. And I think now the market's very greedy, and you can see that if you look at certain models. We measure greediness across global risk appetite. So I think we're just at that stage where there's going to be a trigger, and then we'll get some of this turbulence we've been talking about. And what that trigger is always very difficult to know. But you know that the positioning is there, the exuberance has been building. I mean, you could look at single stock call options, for example. Retail traders love to trade single stock call, as I'm sure you probably talk about them quite a lot. I mean, the volumes of those have been surging in the last few days, as you've probably been talking about.
Yeah, we're going to talk about it later this hour more, too.
Are you? Okay,
yes,
great.
We are, with an option strategist.
Well, that's fantastic. But it's in aggregate, it's a great demonstration of exuberance, people getting a little bit carried away. When in aggregate it gets quite high, the volume's being traded. So that's kind of a confirmation of a lot of risk appetite models, fear and greed models we look at.
So when you're doing positioning, and what you're recommending to clients then is to get more defensive, or at least to hedge against that possibility that things could get a little rockier?
Depends entirely on your time frame. If you're a short-term, month-by-month guy, be cautious. If you're medium-term guy or girl or whatever, then
we can use the non-gender guy. It's fine.
Is that okay? Non-gender
Yes.
guy, yeah. But if you're medium-term, then I take advantage of any weakness. So I think the medium-term trend, the multi-quarter trend, is up in global equities, US equities, and so on. But there's a rotation going on that I think will go on within the market, and I think you want to use dips as opportunities to add to risk.
Gotcha. I'm also curious, since you're based in London, you're over here for a bit, but I'm always curious to ask about perceptions from elsewhere, right? So here, markets seem to be largely shrugging off the tariff headlines at this point. And of course, the UK and the US have sort of an agreement in principle in place.
Yes. Yep.
But still, how are investors in the UK and Europe kind of viewing what's going on?
Well, you know, it's amazing. I mean, it didn't get any headlines, but the UK last week took out 9,000 on the FTSE 100, which is a level it's never been at. It's actually been quite strong this year. It's up sort of 12%. If you look at some of the sort of domestically focused stock markets in Southern Europe, like Spain, I love to look at Spain. It's been a sort of favorite of mine for 12, 18 months. It's just taken off. I mean, there's some really good things going on in Europe. It's quite bizarre because it hasn't happened for 15 years.
Yeah.
So, there's a story building, and you can see the underlying fundamentals that play into it. And the markets are starting to reflect it. It's interesting. I mean, we've had eight rate cuts in Europe. You know, you've had 4 in the US. There's twice as many cuts. That makes a difference, and things start to, you know, the cogs start to grind. The economy starts to think about turning up, and the market anticipates it.
Well, it also feels like for the first time in a long time, there is a discussion around how to change culture and regulation around entrepreneurship and business in Europe. Do you take that seriously? Is that, and that change is not going to happen overnight, obviously.
It doesn't happen overnight, but things are happening. Germany's doing its fiscal, Europe's doing more sort of NATO defense spending. They're trying to build a defense industry. And you're quite right, they're talking about entrepreneurialism, deregulating banks. I mean, this stuff takes time, but it's like the icing on the cake. If you got rate cuts and a normal cyclical recovery and you chuck that on top, you can get a little, Europe is never going to be, a sort of US superstar economy, but it can have its day for a few years, and I think that's what's happening, what's brewing.
Does that imply then that, taking out that 9,000 on the FTSE, the rally that we've seen in Italy, that has more room to go?
Yeah, I think there are more legs to it, absolutely. I think we're just getting going. I mean, if you look at the valuation gap between the US and Europe, better stocks in the US fundamentally, but the gap is wide. And there's some potential there for that to close. And actually, the banks have been doing very well in Europe for like 12, 18 months. And I think there's a broadening into other sectors that will come. I like Europe.
Okay. Chris, thanks for being here. I appreciate it.
Thank you.
Well, coming up, travel earnings and picks. That's what we're going to talk about ahead of some hotel earnings this week. All your markets action coming up. You're watching Market Catalysts. While big tech may dominate the earnings conversation this week, there are a few other key sectors reporting that could give insight into the strength of the economy and the consumer. We want to focus in on travel. Hilton, Wyndham, Southwest, and more are reporting this week. Yahoo Finance's Jared Blickery joins us now with a look at how travel stocks have been performing. Hey, Jared.
Hey, Julie, we've seen travel stocks along with many other stocks really jumping since that April 8th bottom. And behind me is the heat map that we're looking at for travel that we have seen today. And let me just put since that April 8th bottom on here. And you can really see some of the airlines that are jumping the most. United up 23%. We have Delta up 18%. American up 17%. And some of the factors that are contributing to this are 6 record days in 2025 alone, but we're also seeing higher fuel costs. We've got pilot contracts in the mix. So let me just show you some of the charts here, and then we can go through some of those fundamental factors. And I'm going to be focusing mainly on the airlines here. So first up is United Airlines. Now this is a 6-year chart. This goes back to pre-pandemic. That's why I selected that time frame. And you can see it was bouncing around near the lows for many years, and only in 2024 did it manage to climb back into the green, took a nasty dip off of those January, February highs, as all airlines did. And by the way, they were all down about 40 to 50% for the most part, and now it's trying to climb up to break even there. Now let's take a look at the biggest US carrier, Delta Airlines, and we can see that's also a very similar chart to the one we just looked at, underwater by a little bit more, but for the most part spent a number of years chopping around near those lows, then it finally broke higher. And then let's take a look at Southwest as well, because that has a high exposure to the Boeing cycle in the 737 MAX. And Southwest was actually able to climb back into the green in early 2021, but then it sank and it hit new lows, new post-pandemic lows in 2023. And it's been hard for it to just kind of get off the ground here. Let me just show you the airline schedule that we have, and this is what's happening this week from Alaska to Southwest to American Airlines to JetBlue. And I'm going to tell you some of the things that are in the mix right now. So premium flyers and high-income flyers, they are still trading up, and that's really lifting the premium revenues at Delta and United. Economy fares, they're a bit unsteady right now, but as I was saying, we've clocked some record days for the TSA in the U.S. flying industry in 2025, so that points to some high demand. Fuel costs, we got to talk about that because they have edged higher by about 10 cents in the last month to $2.29, lower than a gasoline, but also you don't have as many government taxes in there. But we are still 15% below those peaks that we saw last year. So something we want to keep an eye on, especially as we've seen commodity prices very variable. And then capacity. Capacity has been crimped by these aircraft delays, especially at Southwest. Boeing and Airbus are missing their narrow body delivery targets, and this is limiting 2025 seat growth for some of these companies, but it's also propping up fares. Then we have labor inflation. I talked about some of those pilot contracts. Those new contracts are adding a 3.8% wage jump for this year. And for first year, that jumps to over 20% at the major airlines. This is something that, especially at American Airlines, you're going to watch, see what happens with that this week. And I talked about the demand boom. And then I just want to kind of skip to the operations and IT risk, because we had a couple of incidents. Alaska's weekend ground stop, that's still kind of haunting it. And then Delta's ongoing $500 million CrowdStrike outage. That's going to be something that's in focus, especially on the calls. And that's been keeping reliability and also spending on tech at all the airlines as front of mind. So let's take it back, and I'll show you what's happening today in the travel sector. We're also looking at some of the hotels here, so I'll show you a couple of those charts. Here is Marriott, and let me get a year-to-date up for Marriott. You can see this is actually a pretty similar chart to a lot of stocks in the travel industry, where we saw that big dip from the February highs to the April lows, and a bit of a bounce back here, still trying to break even. And I'll close here with Hilton up 10.2% over this time frame, and you can see it has climbed back in the green as of June. I'll send it back to you, Julie. Excuse me.
Thanks so much, Jared. Appreciate it. Let's get more on this now. We're navigating how to play the travel sector with the Yahoo Finance Investor Playbook. Hilton, Wyndham, Travel and Leisure, they're among the companies reporting this week. And joining me now with his take on some of those top performers is David Katz, Managing Director at Jefferies. David, it's good to see you. I want to start sort of high level here on the travel industry and whether we are seeing demand come back in a way that could benefit sort of a wide swath of these travel providers. What do you think?
Yeah, I think demand for travel is relatively solid, but there's a couple of important threats to it. The most important threat is the inbound international travel. You may remember that, last summer, the value of the dollar was high and it was cheaper to travel abroad. And so the balance of inbound versus outbound was unfavorable for the North American oriented hotel companies. This year was supposed to be an easy comparison in that regard. And with the dollar being down, it should have followed through, but it has not so far. And I think part of that is the frankly unfavorable light in which people are looking at international travelers are looking at U.S. cities. The number one inbound market into the U.S. is Canada. And they have not been traveling to Florida and Arizona and the U.S. As expected. And so, that's, I think, the biggest threat to what is otherwise some very solid demand, Julie.
And does that mean that sort of more domestically oriented lodging companies, for example, could potentially do better in this environment?
Well, yes. And it's one of the reasons why, and I'm sure you'll get to this, why we've continued to have a buy rating on Wyndham hotels. They're roughly 70% drive-to travelers, and that implies more of a domestic orientation to it. People are always going to travel. It's a question of where and how they get there. And at the moment, yes, there is more domestic inbound travel than outbound or inbound international travel as well.
Well, Wyndham reports on Wednesday, right? And the stock is down about 14% year to date.
Yeah.
So do you foresee them giving some better news in there that could help turn the shares around?
I do. Look, we look at, starting high level, we love the Hotel C Corp business model, including Wyndham and Hilton and frankly, all of them, right? They don't own real estate. They don't fund CapEx. They earn fees. Their returns on invested capital are fantastic. They return a ton of capital on an annualized basis, and Wyndham is certainly a part of that. They tend to be limited service and economy oriented and pure franchising, right? Great business model. At the moment, if you look at the RevPAR numbers that are coming across in limited service and economy, they have been somewhat weak. There has been concern about consumers at that end of the economy. And so, we're seeing weekly RevPAR numbers that have been, down modestly pretty much for a year plus now. And while what is the key driver of returns and those stocks is really growing their system or net unit growth, and Wyndham is going to grow theirs as much as 4.5% this year. There is still this weekly focus of the RevPAR numbers that's sort of a bad catalyst. I think they're going to come on and report a very strong quarter, right? They may, the RevPAR number is not going to be great, but the NUG is important and the ancillary fees are very important. And so I do think they're going to have a strong quarter.
Gotcha. And for those who are not familiar, by the way, revenue, RevPAR, revenue per available room, unit revenue, in other words, is what we're talking about here. Hilton is the other company that's going to be reporting on Wednesday. There too, I know you're focused on that net unit growth. In other words, like how many more rooms are there going to be, right? That's what we're talking about here. Right. Are they also going to be seeing that kind of growth this year?
So theirs is actually a little bit better. And I saw your colleague putting up some stock performance charts, and Hilton's outperformed its peer Marriott considerably. And part of that is the growth profile that they have. And that growth profile is manifested in net unit growth, right? They're guiding 6 to 7% this year. Now, I think when we get into where that's coming from, a good portion of it is coming from conversions, meaning existing properties that are either independent and choosing a flag, or they're choosing from another flag into Hilton. And, Hilton has been a share taker in that regard for a while. And I think it's why they get the valuation premium, and it's why they've gotten the stock outperformance. In terms of what you're going to see and hear from them, there again, RevPAR has not been fantastic. But I think when people look at Hilton and they look at this group, they're much more focused on net unit growth and the ability to sustain that growth profile. And then what they do with the fees, returning capital, has been just a huge piece for Hilton and its peers over the years.
And David, I'm curious, you have a buy rating on those two names we talked about, Hilton and Wyndham. You don't have buys on all of your hotels that you cover. Mm-hmm. What sort of distinguishes the ones that are still a good buy versus the ones who aren't? I mean, if there are some generalizations you can make besides the individual.
Yeah, good question, Julie. So look, I think and I've been covering large hotel companies for a really long time. And I'm going to admit this on live television that I've outsmarted myself with them, I don't know how many times, right? Because if you look at the long-term stock charts of Marriott and Hilton and Hyatt, to that end too, and, Wyndham and Choice too, right? Every market event, every dip has proven to be an excellent opportunity to buy some or just buy more, right? And I think the distinction we're making, to answer your question directly, is that the net unit growth is one of the key drivers. The ability to add units to your system is the key driver. What I think is true across the whole market, certainly true in my coverage and true in hotels, is that when you get sucked into the argument about valuation, this one's more expensive and this one's cheaper, it's been a losing argument. The ones that can put up the top line growth and sustain it and accelerate it and generate good returns, return capital, those are the stocks, those are the business models that win, and those are the stocks that win.
David, thanks a lot. Really appreciate your perspective.
Thank you.
Coming up next, we got some more trending tickers for you. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance Live. I'm Alec now live at the NASDAQ, and let's take a quick look at markets here. We're seeing green across the screen. Gains are being led by the tech-heavy NASDAQ composite, up around 0.8%. The Dow is up over 200 points. The S&P 500 is up around 0.6%. We're even seeing gains in the Russell 2000, the small cap index. This is up around 0.8%. And if we take a look at Treasury yields, that's sticking out to me. The 10-year yield is hovering below 4.4%, and the 30-year yield is below 5%. Now, I also just got off a mid-year outlook call with Charles Schwab and T. Rowe Price. And as we move through the second half of the year, investors are reassessing risk, they're positioning what's next for markets. And I want to focus in on risk because according to Schwab's latest survey, tariffs have emerged as the top perceived risk. 72% of advisors and 61% 81% of retail traders flagging tariffs as top areas of concern. Geopolitical tensions and inflation also followed behind there. And then notably, around 40% of each group continues to cite stretched equity valuations as a key threat. And that's something that we've been continuing to discuss and talk about as earnings season kicks off. We saw that reaction in Netflix shares on Friday, closing down 5% despite a beat and raise. And that comes as investor expectations remain high. So even though the bar heading into earnings season was lower, investor expectations still a high bar to cross there. And I also want to talk about Fed rate cut expectations, because we have seen a divergence in opinions. In 2025, the majority of advisors expect 1 to 2 cuts. Retail investors are leaning a bit more conservative, but still the majority see just 1 cut. We know the Fed dot plot that we received in June showed 2 cuts by year end. That probability has gone down as economic data remains strong and inflation continues to be a bit elevated. By 2026, though, both groups shift more dovish, with the majority anticipating 2 or more cuts, broadly aligning with Fed expectations there as well. And then finally, bonus takeaway is that positioning-wise, we're seeing a rise in equity exposure, particularly for retail investors. And there's also a strong home bias. So most retail investors, they're continuing to invest in the U.S. despite more attractive valuations abroad. So really a lot of what we've been echoing when we're hearing about the state of the U.S. economy, the state of the stock market, really solid levels at this point. But that doesn't mean that there are not risks ahead, and we could potentially see a bit more choppiness there. And we will be hearing from another big name at Charles Schwab, Lizanne Saunders. She will be joining opening bid on Wednesday at 9:30 a.m. Eastern, so make sure to stay tuned to that.
Now time for some of today's trending tickers. We are watching CoreWeave, Opendoor, and Apple. Back with me now, senior markets reporter Ali Canal from the NASDAQ. And first up, let's talk CoreWeave, Ali. It is rising after announcing a $1.5 billion bond sale. The company says it's going to use that capital for general purposes, including paying down debt. Those notes due in 2031. So raising debt to pay down debt. The share's up by 7% here today. But as we know, CoreWeave has just been, it's been hot.
It's been hot off of that AI trade, right? The AI investments. And we have seen a few key investments here. A $6 billion AI data center in Pennsylvania, a $9 billion deal to acquire Core Scientific. Both of those aiming to boost some of that control when we look at AI infrastructure. Shares are up around 7% right now. We're more than tripled since the March NASDAQ debut. Again, a lot of the AI demands that we've been discussing, along with the fact that some of the top clients for CoreWeave include big names that we know well, like NVIDIA and Microsoft. Of course, there's a lot of risk here. Some analysts have called out questions on how sustainable CoreWeave's debt-fueled growth can really be within this market. But as you were just saying, it's just been on a hot streak right now. Really a lot of those AI touch points that investors are looking for.
Yeah, and next up, the meme stock style rally continues for Opendoor. The stock has been soaring this morning after it was up 180+% last week. And this all follows a bull thesis for Opendoor's turnaround. That was posted on X on July 14th. The stock right now is up. I didn't want to read it because I wasn't sure if it was right, Ali. It's up 87% today.
I mean, it's nuts. Retail enthusiasm, momentum buying. The stock is on Wall Street Bets, which we know really started that GameStop meme stock craziness in 2021. Now, shares are still well below their 2021 peak of $39. And just a month ago, the stock was trading below $1 a share. Recently dodged a NASDAQ delisting warning. So fundamental case, definitely not there right now. The company has never posted a profitable quarter, just settled a class action suit tied to its pricing algorithm. Short interest topped 25% of the float at the end of June. So very much a high risk name here, but we are in this environment where retail traders are chasing a lot of those momentum names. So, I'm not totally surprised, but like you were saying, 87% rally in a day. That is telling you this is meme stock, retail traders all over it.
For sure. And finally, let's talk about Apple. Its rumored first foldable phone is getting some buzz right now. Last week, an Apple analyst from TF International Securities reported the tech giant has plans to make that folding iPhone next year. Now there's a Bloomberg report highlighting what would make this launch so different from prior iPhone launches, and that's that Apple is usually at the forefront of innovation, but in this case, it will be behind others who have already pioneered the space. However, reporter Mark Gurman arguing its ability to market premium hardware to consumers could make it the dominant player in the space within months of launching. And, it's not always on the bleeding edge. Sometimes it comes in later and just comes in with a more premium product.
Exactly, Julie. That's what I was going to say. We've seen this before from Apple. They're not always the innovators, but they let the innovation happen and then they come in and build that better product. So with the foldable iPhone, I think you can look at their brand recognition. You can look at the demand for iPhone users that have been waiting for this, but maybe didn't want to switch over to an Android. They still wanted those blue bubble texts to pop up. So that could be a boon there. And also for the Chinese consumer, they are used to foldable phones. That's a preference there, so we could see a potential rise on that front. The reported pricing is expected at around $2,000, so boost to revenue if unit volume can stay a bit moderate there. And this could be a good catalyst for Apple. We've seen the stock really struggle, especially this year. Shares are down 15%, and they really need a win if they want to compete in the AI race, which we know they've been lagging behind. That's one of the reasons why we've seen shares struggle. So if they're not able to fully catch up on that front, then if there is more innovation on the iPhone front and they can attract more of those consumers, that could be an area where they could continue to win as well.
I don't know about you. I'm not interested in the foldable phone. I don't know what the value proposition is there.
I agree.
We'll see. Maybe we'll be convinced. All right. Thanks, Allie. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, retail investors are driving record single stock option volume this year. Among the favorite names, Magnificent Seven member Tesla, which reports results later this week. Joining me now is Henry Schwartz, Vice President of Derivatives Market Intelligence at Cboe Global Markets, which operates the world's largest options exchange. And I want to talk big picture, but first I want to zoom in on Tesla. Henry, thank you so much for being here. Because Tesla is an options favorite. So what are we looking at ahead of the earnings?
So, I mean, retail investors love to use options on these Mag 7 stocks. These are the stocks they pay attention to. These are the stocks that have a lot of volatility, so you get big moves up and down. These are the stocks that are in the headlines. And Tesla's been really interesting, right? Because it really kind of got away from the value as an electric car company a long time ago, and now it's just a story stock. So what we're seeing in terms of trading into earnings is actually similar to what we're seeing in most of the Mag 7 names. We're going to see 6 out of the 7 are reporting the next 10 days. The options actually are kind of saying that the reaction to earnings is not going to be anything of a blowout. And that makes some sense because that's not really what's driving, certainly not what's driving Tesla.
Right.
And even kind of most of these, it's the story around the stock. It doesn't really have a lot to do with straight up financial results right now.
Right, at least not for this quarter, especially since we know that Tesla's numbers around its fundamental business are probably not going to be fantastic.
Exactly.
So interesting to pay attention to that. I want to bring up another stock that we were just talking about, and that is Open Door. Because when I see an 80% plus one-day move in a stock, I assume that options are a part of that move. Is that a correct assumption?
It absolutely is.
In some way, shape, or form.
It absolutely is. Actually, I went and looked quickly at kind of the history on this symbol. It's not the most active name. However, today we might see over 2 million option contracts trade out of a market total for the single stock space of about 20 million contracts a day. Wow. So for Open Door to be trading 10% of the volume, that's bigger than the average daily volume in Apple and Tesla. What we're also seeing is very interesting is the implied volatility, which is a measure of the prices of options in Open, is around 400 to 500% right now. And what that actually tells you is that the market is expecting this stock to move on average 35 to 40% a day for the next couple of weeks. So this is not really going to go away. And it's funny, when Open was a 50-cent stock about 3 months ago, many people would say, well, actually, the stock's kind of like an option, right? It can only go down to zero, but maybe it has, kind of unlimited upside, just like a long call. Now that you're kind of in that, approaching $4 or $5 spot, I think many people would say that the stock still is like an option. But but people go into the options, particularly upside calls, for the leverage and for the kind of the convex payoff. It's a little bit like what we saw in GameStop in 2020. You capture the attention of a lot of traders, and to see just immense amounts of activity. It's primarily retail that's coming into these, but then when you see this kind of flow, it pulls in kind of pro-tail, basically semi-professional retail, and institutions as well.
And this huge wave of option trading that we have seen, not just in Open Door, but in general, is it mostly sort of vanilla call buying, or have traders gotten more sophisticated as well?
So it's a good question. So really during kind of the COVID era, a lot of new retail traders came into the market, and call buying really was kind of the primary activity, and it makes sense because it worked very well. We had such an explosive rally after kind of the bottom in 2020. You could kind of say the same thing about how we've done since the beginning of April, right? We've had a monster rally that I think surprised a lot of people, and anybody involved in upside calls generally kind of traders tend to come into those from the long side because of the fact that the risk of being short a naked call is is infinite technically. So we do see a lot of outright call buying, especially in a meme stock style name. But then we are seeing more sophisticated activity, particularly in the zero DTE options on SPX, which is the S&P 500 index. The two big stories over the last couple of years have been retail activity and short dated and zero DTE trading. And in the zero DTE trading, it's a little bit different. People actually tend to sell options, but they do it in a capped risk, like a vertical spread. And there's a very active community that does that continuously, almost like a quantitative strategy. Some of them use tools that let them actually trade it automatically. So there is more sophisticated activity. But I have to say that when you get into kind of these names that go up 20, 30, 40% a day, that's not the most sophisticated flow. That's people jumping in because they really, really want the payoff profile that derivatives give them, particularly the upside call on a stock that's jumping.
We were just showing a chart that you brought us that shows that zero TD option volume, non-institutional meaning retail, on a daily basis. This is what it tends to look like. What is this chart? What story is that chart telling us?
So this is actually, I showed this at a conference and everybody was kind of flabbergasted. The customer base that is using zero DT options and selling vertical spreads, okay, they're trying to basically put bounds around the market and say, listen, I think the market's going to stay within 50 basis points today, so I'm going to sell spreads that are outside of that range. What's really interesting, what this chart shows, is that there's kind of a time signature to that. So we see spikes at 10 a.m. and 10:15 and 10:30 and 10:45, really on every 5-minute node, we're seeing a spike in activity. That really is these traders coming in with automated systems to try to harvest premium. But what's really interesting is you look at this chart, and even people that haven't traded options much, they kind of realize, well, gee, I don't think it's a great idea to jump in right when everybody else is jumping in. So this kind of creates a dynamic where people are like, well, listen, if I'm going to do this strategy, and there's traders that have great success with this strategy, just like anything else, it's not, there's no free money out there. But you have people saying, okay, well, maybe a second before that, the 10-minute interval is really when I want to make my trade. So, but that activity, we're seeing in the SPX 0DTE about 1.5 million contracts a day. It's more than half of the activity consistently, and it's not just in SPX. We're seeing it in the other big indexes and ETFs that have these daily expirations.
So let me ask you this, Henry. We are scratching our heads and saying there seems to be a lot of obstacles to stocks going higher, and yet stocks keep going higher. How much of it is this type of activity?
I don't think that the tail is wagging the dog when it comes to kind of options versus the underlying. Options provide they have leverage kind of inherent to what an option is. They do let customers, particularly retail, get into stocks that are expensive, right? So the kind of the why on why we're seeing just new all-time highs, even though there are some major macro and geopolitical tensions. I actually had a colleague ask me at work last week. He's like, "Why does the market keep going up?" I said, "You know what? It's where people are putting their money." And and in the end, we saw what April was like. Right? April was a big shock. Yeah. There was a lot of fear. We know that kind of trading off emotion is detrimental. It does not work. And so, I think the market definitely has kind of an optimistic view right now. But, and they could swing the other way. But it's there's a trend there. And, as traders say, the trend is your friend.
Yes, I guess if you're an options trader, it can really be your friend if you supercharge it. Henry, thank you so much for being here. Appreciate it.
Sure.
Well, coming up next, we've got stocks in translation, and we're going to check in with our Jared Blickery. You're watching Market Catalysts. Several companies that are not in the banking business are suddenly applying for new U.S. banking charters, including General Motors, Stellantis, and Circle. They aren't looking to become full-service banks, though. Joining me now to explain, banking reporter David Hollerith. So what's going on? Why are these companies doing this?
Yeah, well, so the most obvious answer is with the Trump administration, which has signaled and begun making kind of a broader deregulatory push in financial services. There have been a lot more charter applications. And the interesting thing is that non-bank companies wanting to get bank charters isn't exactly a new thing, but all these new charters kind of signals that they see a higher chance of getting approval with the Trump administration now in power. And the other side of this too is we just had this stablecoin bill that passed. And so a lot of the crypto firms that issue stablecoins will now be regulated by the OCC, a federal bank regulator. So they are kind of seeing this as also like a way to get credibility, check the box with the bill. And also too, banks will now begin to issue stable coins. We are imagining, that's what some banks have signaled. We'll kind of see how that plays out. And if these firms want to compete against them, there's sort of a credibility edge that they kind of need to with institutional clients to have a bank charter. So kind of two separate themes here with commercial companies trying to do it.
And it's interesting to see all of those melding of the lines between the organizations. But okay, so what does a bank charter do for a company, for example? Like a General Motors, what would it be able to do with a bank charter?
Yeah, so that's the other thing is that we're mainly seeing these new companies apply for two kind of, I guess you would call them novel bank charters. They're not looking to become full service banks. Right. So what they want to do is they want to either go for the FDIC's industrial loan charter, which is kind of what these automakers are looking at. And then also all the stablecoin companies are looking at the national trust bank charter. So they're not trying to do effectively the same level of regulation that bigger banks have to do. And so a lot of the banking industry is actually kind of upset about this.
Interesting. Why are they upset about this? Just more competition?
Yeah, it's more competition, and in some ways they feel like this is an attempt by non-bank companies to sort of do a little bit of regulatory arbitrage. And so we kind of have to see how that plays out. And obviously just by having these more novel charters, it's not really a bad thing in itself, at least they've argued. But we have to see whether or not they can still kind of do the same things as other banks. And so that's kind of been the whole trend here. And it's kind of around more competition in general, which could be good for consumers, obviously.
And we'll see if the regulators successfully regulate this stuff too, I guess is another part of the question. Anyway, really interesting story, Dave. Thank you so much for bringing it to us. Appreciate it. That's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.